Hi, I'm Scott Jacobs, partner and wealth advisor at WRP Wealth. As we move through the early part of 2026, the market backdrop feels familiar. Inflation is still part of the story, interest rates still matter, and markets are trying to price all that at once. One simple way to anchor that is broad U.S. equities. For example, the SPY, which tracks the S&P 500, has been trading around the high 600s per share as the most recent data we have while recording. And I'm not recommending SPY or any specific investment. I'm using it as a reference point. Prices move day to day, but it helps frame the environment. We're not in a dramatic boom or a dramatic sell-off. We're in a market that's still digesting rates and inflation in real time. On inflation, price pressures have eased from the peak a couple years ago, but they're still running above the Fed's long-term target. The most recent CPI data showed inflation in the mid to high 2% range over the past year, with core inflation in a similar range. Interest rates remain a focal point because they affect how investors value everything from growth stocks to real estate. The 10-year Treasury yield has been in the 4% plus range recently, and that's a level that keeps the rate conversation front and center. And on Fed policy, the federal funds target range was reduced about 3.5% to 3.75% at the end of last year after a long tightening cycle. Markets are still watching what comes next, but the big picture is that policy remains meaningfully higher and that pre-inflation era. For high earners, business owners, and executives, the more useful focus is often on making sure the framework is solid because cash planning, taxes, equity comp timing, concentrated positions, and longer-term decisions like estate planning will interact with the backdrop. This is general market commentary for information purposes, not personalized investment or tax advice, and investing involves risk, including loss of principal. But early in the year is often a useful time to step back and ask, are the pieces of your plan still aligned? Especially if income changed, equity events happened, or complexity increased recently. If you'd like to make sure your framework is still aligned, we're happy to start with a conversation.